Welcome to the Coin Bureau Weekly Crypto Review. Here are this week's top headlines in the crypto news. The Dogecoin Foundation returns. Dogecoin's organizing body comes back to life with big-name advisors and big plans. Could Doge finally become more than a meme? Money printers to pause. The US Federal Reserve has revealed that it's looking to reduce its asset purchases as early as this year. Why this could break both the stock market and the crypto market. The big boys on the crypto block. Coinbase details its plans to buy hundreds of millions of dollars in crypto, while some of the world's largest asset managers look to do the same. What you need to know. Corporations crazy for crypto. Microsoft and Walmart are looking to leverage crypto tech, but the outcome of their intentions could be anything but crypto-friendly. Here's why. DeFi's doomsday clock. SEC Chairman Gary Gensler doubles down on his desire to destroy DeFi as prevalent personalities in the space sound the alarm. What comes next? Papers, please. Binance imposes KYC and regulators begin targeting other global exchanges, which could soon follow suit. Here's how you can accommodate these new restrictions. Monero's major milestone. Atomic swaps between XMR and BTC go live on Monero. Could this kill the other competitors in cryptocurrency's privacy niche? And a closer look at what might be the most important week for this bull market in this week's Crypto Market Forecast. All this and more in just a moment. Good morning, afternoon, or evening. Thank you for tuning in. My name is Guy, and what you're about to see is educational content, not financial advice. You can find any topics you're looking for using the timestamps in the video timeline. And now for today's top stories. The Dogecoin Foundation has been officially re-established after over 6 years of silence. For those who don't know, the Dogecoin Foundation is a registered non-profit in the United States and was founded way back in 2014. The foundation was behind various wholesome initiatives, such as funding the Jamaican bobsleigh team to compete in the 2014 Winter Olympics in Sochi. In a short announcement last week, the Dogecoin Foundation detailed its new constituents and plans to support Dogecoin development, quote, protect the Dogecoin brand, and raise funds to put these plans into action. In terms of personnel, the Foundation board features various OG Dogecoin devs, and its advisory panel includes Dogecoin co-founder Billy Marcus and even Ethereum founder Vitalik Buterin. Neuralink CEO Jared Birchall is also an advisor to the foundation, and he will serve as the mouthpiece for the Doge father himself, Elon Musk. Together, this team hopes to accelerate Dogecoin's development while abiding by the 4 tenets laid out in the freshly penned Dogecoin manifesto. These are to be useful, be personable, be welcoming, and be reliable. A roadmap for Dogecoin's future developments is currently in the works and will presumably be released once the foundation has finished raising funds. Now, although all this news is very bullish for Doge, it's going to take a lot of time to address the issues Dogecoin faces, be its reliance on Litecoin, the Doge whale, or Doge's terrible tokenomics. For the time being, Doge will continue to be funny money, which is ironically less funny than the money being made at the Fed as of late. Last week, there was a flurry of headlines about the Federal Reserve's plans to taper its asset purchases as soon as September. Now, I know this sounds like a bit of a word salad, so allow me to explain. Contrary to popular belief, the Federal Reserve doesn't print money per se. This is basically because the Fed isn't allowed by law to give money to the US government directly. So to skirt this regulation, regular banks will lend money out of thin air to the US government in exchange for bonds, which are promises to pay back the money that was borrowed plus interest by a certain date. These bonds are then purchased from the banks by the Federal Reserve, which creates money out of thin air to give to the banks which initially purchased these bonds from the government. Since late last year, the Federal Reserve has been buying over $120 billion in assets every month, primarily through government bonds. Now, if you're wondering why this matters, it's because the demand for bonds determines the interest rate on debt in the economy. When the demand for bonds is high, the interest rates are low, and when the demand for bonds is low, the interest rates are high. Right now, interest rates are being kept artificially low by the Fed, which is keeping that bond demand high with its purchases. However, if the Fed tapers, i.e. reduces its purchases, the interest rates on debt will rise, and this means that anyone who's borrowed too much money will instantly get wrecked because they won't be able to afford to pay off their debt payments. As you can imagine, many individuals and institutions have been borrowing like mad over the last year to invest, so much so that Morgan Stanley predicts a 5% correction in the S&P 500 could crash markets across the board. Minutes of the Fed's most recent meeting suggest the Fed could announce this as early as September, in which case all the markets would crash as people cash out to pay back their debts before interest rates rise. Now, the only reason why the market hasn't crashed already is because nobody believes the Fed will actually taper, given that the government itself is massively in debt and could default if interest rates rose. I know this can be complicated and even a little bland, but these macro factors are incredibly important to be aware of because they are what the big money is watching, and the big money is what moves the market. Speaking of big money, Coinbase has announced that it will be making a one-time purchase of $500 million in cryptocurrency and will be allocating at least 10% of its profits to crypto going forward. The best part is that Coinbase is not just buying BTC, but also altcoins. Though Ethereum is the only altcoin Coinbase mentions by name, its announcement makes it easy to guess what the others probably are. First, there's proof-of-stake assets, which will likely be Cardano, Polkadot, and Solana, since they're the largest proof-of-stake cryptos and they're all listed on Coinbase. Second, there's DeFi tokens, which will almost certainly be Uniswap, Aave, Compound, and MakerDAO, along with a few others that are also listed on Coinbase. And finally, there's, quote, many other crypto assets supported for trading on our platform. And I imagine many of these will be a part of Coinbase's personal investment portfolio via Coinbase Ventures. We'll know for sure which cryptocurrencies Coinbase purchased when it issues its next quarterly earnings report sometime in mid to late September. And you can learn about the other companies that could be announcing crypto purchases by using that link up there in the top right. Now, besides Coinbase, BlackRock has also disclosed a sizable position in crypto worth nearly $400 million. And by disclosed, I mean that Forbes had to dig it out from BlackRock's SEC documentation. Rather than invest in cryptocurrency directly, BlackRock opted to get exposure to two crypto mining companies, Marathon and Riot. BlackRock's iShares Russell 200 ETF now owns 7% of both stocks. Investing in crypto mining company stock is one of the many ways that legacy investors are getting exposure to crypto. But according to a recent report by Fidelity, 90% of its biggest clients want to get their hands on the real thing. According to Fidelity Digital Assets President Tom Jessup, quote, what really got people off the fence was the pandemic, because you've got this scarce asset class, there will only ever be 21 million Bitcoin created, and an environment where our currency is being debased and there's a ton of money printing. I couldn't agree more, Tom. Anyways, the reason why this is so significant is because Fidelity custodies over $10 trillion in assets. If 90% of Fidelity's biggest clients want to buy crypto directly, this could mean billions, possibly trillions of dollars are just itching to get into the crypto market. And it's not just investors that are crypto crazy either. Walmart is looking for a digital currency and cryptocurrency product lead who will, quote, identify crypto-related investment and partnerships, among other things. In case you haven't put two and two together, this suggests that Walmart could be adding support for cryptocurrency payments and possibly even crypto products of some kind. This is what happened with PayPal a few months after it had posted an advert for a similar job last year. And it's likely what will happen with Apple, which recently opened a similar position. Another company that has been keen on adopting crypto is Microsoft, which recently released a paper detailing how it would like to use the Ethereum blockchain to fight piracy. Not literal piracy, of course. The piracy it's fighting is the kind that involves downloading copyrighted content for free. This is a bit ironic, considering most of the money you'd have paid would have gone to a middleman and not the content creator, at least if we're talking music. More about that up there in the top right. In any case, Microsoft's Ethereum piracy protocol is titled Argus, and it involves an extremely elaborate set of incentives and tracing mechanisms that could be easily replaced with NFT technology. This is because NFTs can be programmed to give a portion of any sale or transfer fees to the original creator. This would of course be the ideal setup, but then there would be no need for Microsoft and all its overreaching technologies, and that would be very bad for its shareholders. The same is true for banks when it comes to DeFi, and it looks like the DeFi space is about to have one hell of a battle on its hands. For what must be the third week in a row, SEC Chairman Gary Gensler has been taking swipes at DeFi during his public appearances. The most recent of these took place last week when Gary told the Wall Street Journal that most DeFi protocols are centralized and will have to register with the SEC if they want to service US citizens. He later noted that cryptocurrency won't continue to grow if it doesn't start operating within the bounds of existing financial laws. Now, to be fair, Gary does have a point when it comes to the centralization of certain DeFi protocols. He's also not wrong that many elements of cryptocurrency would stand to benefit from some form of regulation. However, the problem is that these regulations are often written in the interests of the powers that be, and in this case it's the big banks, which Gary is all too familiar with, given that he's been a high-ranking Goldman Sachs banker for half of his career. As I explained in my video about the SEC's clampdown on cryptocurrency, we probably won't see any significant action coming from regulators until late September, when all politicians have returned from recess. The thing is that some politicians are set to convene today to push through the two multi-trillion-dollar spending packages, one of which is the now infamous infrastructure bill. Whether or not these bills will get rushed through before House politicians return from recess at the end of next week is something I don't know, but what I do know is that once that bill is signed into law by the President, it will be fair game for regulators. This is because the wording around the crypto tax provision that requires so-called brokers to collect KYC is worded so broadly that it can be applied to just about anyone. Methinks the projects at the front of the firing line will be related to DeFi, and stablecoins will likely find themselves in the crossfire. This is yet another macro factor to keep in mind, and it's one that's been pushing cryptocurrency exchanges to comply with regulations before the big guns come out. Some of you may remember me mentioning in one of my previous weekly crypto reviews that you always have to have a backup account on another exchange in case anything happens to your favorite exchange. As much as they try to promise what they will and will not do, you never know how things will be when the rubber hits the road, and Binance is an amazing example of this. Just a few weeks back, Binance said that unverified users would be able to withdraw up to 0.06 BTC's worth of cryptocurrency every 24 hours. Lo and behold, it is now necessary to complete mandatory KYC on Binance. Thankfully, this new requirement will be implemented gradually between now and October to all existing Binance users, and they'll be notified well in advance as to when they need to comply or fly. Unfortunately, new Binance users must complete KYC to do anything at all. Government regulators around the world have probably seen how effective their sanctions have been with Binance, because now they're going after other large exchanges such as Huobi, KuCoin, and Bybit. The inevitable consequence of this will be KYC across the board, so you need to start thinking about which centralized exchanges you're comfortable giving that information to. Now, I happen to have a video about the top 5 best regulated exchanges, and you can find it up there in the top right. If using a centralized exchange is not an option for whatever reason, you'll have to investigate which DeFi protocols are decentralized enough to survive the clampdown around the corner. With the ongoing scrutiny that both centralized and decentralized exchanges are facing, cryptocurrency projects are taking countermeasures across the board. And one of the most important of these is Monero's atomic swaps with Bitcoin, which finally went live last week. To quickly recap, atomic swaps allow you to trade cryptocurrencies directly between chains without a centralized exchange or custodian. Now, atomic swaps have been a holy grail for Monero for a very long time, because it's expected that XMR will eventually become impossible to purchase on cryptocurrency exchanges due to its privacy protection. Now that XMR can be exchanged for BTC directly peer-to-peer, Monero will have an added layer of protection when privacy becomes public enemy number 1. This begs the question of what will happen to the other privacy coins out there that don't have nearly the same degree of adoption, attention, or development. To be blunt, it's starting to look like there will only ever be one truly private privacy coin, the same way that there will only ever be one true store of value in cryptocurrency. When it comes to the other crypto niches, however, there seems to be room for more than one winner. And this brings me to this week's crypto market forecast. Starting with Bitcoin, you can see that we're continuing a very strong upward trend. There's been a lot of resistance along the way, and the big price point that many are hoping to get past is 50k, which had been breached as this video was recorded. Now, regardless of where we are today, my personal prediction is that BTC will continue moving up this week, especially if those aforementioned spending packages are passed. I know it sounds a bit counterintuitive given the controversial crypto clause one of them contains, but the fact of the matter is that the stock market will rally on the news that trillions will be injected into the economy. Put differently, investors are constantly looking for signs of certainty, and seeing those bills pass the final hurdle will give them enough confidence to double down on their investments, even though the money hasn't actually started flowing yet. Not everyone will see it this way, of course, which is why it could be a very turbulent week for the crypto market, especially for any DeFi tokens. This week's winners are Avalanche, Audius, Arweave, Near Protocol, and Phantom. Finally, a list that I can get on board with. AVAX is rallying on the news that some of Ethereum's top DeFi protocols will be deploying on the Avalanche DAG, namely Aave and Curve Finance. Now, I happen to be a pretty big fan of Avalanche, and you can learn more about it using the link up there in the top right. If you're wondering where AVAX is headed next, it honestly looks like we could see some new all-time highs this week. This is because AVAX has broken past most of its previous zones of price resistance, and if it can hold on to the $40 range over the next day or two, that'll be a sign that it's ready to keep rallying. Unfortunately, the same can't be said for Audius, which has rallied harder than any other cryptocurrency in recent memory. Now, this rally was roused for a very good reason, because Audius integrated with TikTok last week, making it possible to use music from Audius in TikTok videos. Now, I covered Audius in depth in the days that followed, and I'll leave a link to that video in the description if you want to get my full take on the project. All I'll say here is that Audio's price looks a bit iffy. Those long wicks mean people have been taking profits. Now, that said, if Audio can hold above the $2.70 level, we will hopefully see positive price action later this week. I'll admit my bias is a bit bullish simply because Audius is part of Solana's ecosystem. Arweave is another cryptocurrency in Solana's ecosystem that I've been watching closely, and it's actually one I'll be covering later this week. The reason why the AR coin has mooned so hard is because Arweave stores all of Solana's blockchain data. Solana has seen a lot of activity on account of NFTs involving degenerate apes, and has likewise seen an uptick in DeFi usage, with Solana DeFi protocols holding an estimated $2 billion in TVL. Every single transaction is stored forever on Arweave, and the AR token is used to pay for that storage. That's a lot of demand, and AR's price action is the obvious consequence of that. I expect Arweave to rally alongside Solana for the foreseeable future, so keep your eye on this crypto if you have some soul. Near Protocol is rallying for similar reasons, specifically NFT shenanigans coupled with a strong community and solid fundamentals. The only issue is that the Near coin hasn't performed very well compared to other cryptocurrencies, and I attribute this to Near's insanely aggressive vesting schedule, which you can see here. Now, if Near can somehow push past that massive line of resistance at the $6.75 level, I could see it cautiously headed towards new all-time highs, but this probably won't happen this week. This last winner this week is certainly not least, and that's Phantom, the crypto project which is famous for being designed and coded by Yearn Finance founder André Cronje. FTM is gaining ground because of the various dApps deploying on its DAG, something that's been facilitated by a recent native integration with Chainlink's data feeds. This buzz has attracted thousands of users, as you can see here on FTM Scan. Now, in case you can't see or are only listening, Phantom's user count has increased by nearly 100,000 since the start of August. Like AVAX, FTM has pushed past most of its previous zones of price resistance, but faces a steep battle ahead to its previous all-time high of 95 cents. If the adoption of Phantom continues, I could see FTM blowing past that price point. If you're curious about Phantom, you can get your fill by watching my video all about it, and it's up there in the usual spot, top right. And that's all for today's Coin Bureau Weekly Crypto Review. If you enjoyed it, you know what to do. Hit that like button, subscribe button, and bell icon too. If you want more of me, head on over to Twitter, TikTok, and Instagram to get a sneak peek behind the scenes. If you join my Telegram channel, you'll get the daily crypto updates you crave, and signing up for my weekly newsletter is a great way to get the tools, tips, and tricks you need to get paid. And of course, you can support the channel by heading over to the Coin Bureau merch store and picking up a shirt or hoodie, or both. Links to all these resources are in the description. Thank you so much for watching, and I'll see you all in next week's episode.